Hey, how's it going? Bill Lethman here for Money Evolution. In this video, I'm going to be talking about how your investment income is taxed. So this is something that's critically important for any investor, but really I think it's more important for people that may be getting closer to retirement or maybe people that are already in retirement, because in retirement, you're going to be more likely to start to use some of that money you've built up in some of these investment accounts and start to use that to cover some of your retirement income expenses and your gaps throughout retirement. So we're going to get into all the details here. We're even going to talk about how you could potentially have long-term capital gains or qualified dividends and pay zero taxes on that. We're also going to talk about the thresholds that you need to be aware of that could actually create an extra tax that you could have to pay on your investment income on top of all of the other taxes that you have to pay. So stick around all the way through the video for that. And real quick though, before I get into the content of the video, if you're watching this and you'd like to learn more about what we do at Money Evolution, you can head over to moneyevolution.com. Check out all the things we have on the website. We're building out an entire financial resource library, education hub that's going to cover all kinds of different topics, from tax strategies like we're talking about here, retirement planning, personal finance, and a whole bunch of other things. So again, check out those links down in the description below. So let's jump right in. So investment income is going to cover a whole bunch of different things, but it's really things that are obviously going to derive from investments that you put money into and you get some kind of a return back. And that's going to include things like interest income, dividends you may be getting from stocks. If you sell an asset, you're going to have a capital gain. It could be long-term or short-term. And if you do real estate investing, it could be also included inside of your investment income. What a lot of people may or may not necessarily realize is that there's actually two tax tables. One of those tax tables is what we call the ordinary income tax table. And that's going to be where you're going to see things like your W-2 wages, or if you have net business income, you're going to declare that on your ordinary income tax. And that's going to be your marginal tax rates. That's a tax table that most people are probably familiar with based on the income that you have there. If you have real estate income, that's going to also be included in that ordinary income. And in other investments, if you have interest income from like a bond or a CD, that's also going to be on this as well. Money markets, if that pays interest, that's going to be part of that ordinary income. And short-term capital gains, and we'll talk about it a little bit more, but something called non-qualified dividends. And how do you get non-qualified dividends? What makes it qualified? We'll talk about that here in just a second. So all of that's going to be taxed at your tax table, and any money that you make on investments in that category are going to be added to that. Incidentally, if you take money out of a traditional retirement account, like a traditional 401k or an IRA, that's also going to be added into your ordinary income tax. We're not going to get into too much detail here in this video. The more important one is that people don't maybe understand that there's actually a preference tax rate that you're going to get on certain types of investment income. And that preference rate is going to be always lower than what it is on your ordinary income tax. It could be zero, like we'll talk about that in a second. It could be 15%, and probably for most people, it'll be 15%. And for some people, if you're in a really high tax bracket, it could be 20%. But that preference income is going to be long-term capital gains, and it's going to be qualified dividends. And that qualified dividend, again, that's going to primarily be from dividends that you're going to get from common stock. So if you have Microsoft stock or Apple, Starbucks, that pays a dividend out, that's going to be tends to be a qualified dividend for all of those companies. A non-qualified dividend, probably the most common source of non-qualified, is going to be where you have a mutual fund or you have an exchange traded fund, ETF, that pays out a dividend, but the dividend source of that income is from an interest-bearing instrument. So it's a bond ETF, for example, would pay interest to the bond fund, and then it gets paid out to you as a non-qualified dividend. And again, that non-qualified dividend is going to show up over here in the ordinary income tax. So depending on whether you're filing single or joint, obviously that's going to have an influence on that. But for 2025, we have, if you're a single tax filer, if you have total taxable income that's less than $48,350, you're actually going to be in a 0% long-term capital gains tax rate or qualified dividend tax rate. So again, the way the IRS is going to do this is they're going to stack up any ordinary income first, so that's going to get piled on. Then you're going to be able to deduct the things you can normally deduct from that taxable income. So it's going to be whether you itemize your deductions or taking the standard deduction. If you get any exemptions or anything like that, would be subtracted from that as well. Exemptions have actually been eliminated as part of the Tax Cuts and Jobs Act, but they may be coming back in the future, but that would come off of that. And then any deductions for, let's say, pre-tax savings into like an HSA or a traditional 401k plan or traditional IRA account. That would all go to subtract that. And then that dividend income or long-term capital gains income would be stacked up on top of this. So if all of that ends up being less than $48,350, you would actually pay zero taxes on the dividends, and you would still pay some ordinary income taxes on the other part, but that dividend portion of that or long-term capital gain portion of that would be taxed at zero. Then the next bracket for single, we'll stick in the single here, it goes all the way up to $533,000 and change, 533,400, and if you're above that, you would be at 20%, and if you're in between that 48,350 and the 533,400, you're going to pay 15% on that. So again, if you're in those brackets, it's always going to be less than that ordinary income tax rate. So that's for single, and the married filing joint is going to be a little bit higher here, but that's where this marriage penalty kind of comes in, because the rates aren't like the regular tax tables are right now, where the married filing joint rates are basically, the brackets are about twice what they are on the single filer, except when you get up in the really high tax bracket. But here that goes from 96,700, so that is, I guess that is exactly double, so 96,700 of taxable income or less, you'd be at 0% and then 15% in between, and then that 20% tax bracket kicks in at $600,050. And if you're above that, you're going to be at the 20% tax bracket. So again, even if you're in that highest tax bracket, that 20% is still going to be less than what the top tax bracket is on the ordinary income tax rate, which is right now, under the current tax law, 37%. Next year, if the tax cuts are let to expire and they don't get renewed, that top tax bracket is going to be, I think it's 39.6%, maybe 39.7% if I'm in the right ballpark there on that. But this is a really big advantage. So as you start to look at those monies that you have in those non-retirement accounts, so brokerage accounts that are not part of an IRA or a 401k plan, the money that you invest in those accounts, you can start to think about it, be a little bit more intentional about the types of investments that you choose to buy there, and maybe look at investments that are going to focus more on some of those preference items. So investments that maybe focus on dividends, where you're getting a lot of qualified dividend income, or investments that don't have a lot of turnover within the funds. Let's say mutual funds tend to have to they don't tend to. They have to, by law, declare all of the money that they make on buys and sells of stocks as a dividend or as a distribution every year. And you're going to get some of that maybe as long-term capital gains, some of it may be at short-term capital gains. It can be very unpredictable depending on what the market does and how many people are buying into the fund or taking money out. But that could be something that could some years give a lot of that taxable income. For example, an ETF, which is an exchange-traded fund, is something that can tend to be a little bit more tax efficient. So there's ways to strategize some of the investments that you put into the portfolio so you can potentially minimize that risk there. But that's number one, understanding that and creating some of that preference item of income. Now, the next thing I want to talk about is I want to talk about something that was created in, I think it was 2008 or 2009 with the Affordable Care Act, and it's something called the Net Investment Income Tax, or abbreviated NIIT. And what that is that if you're over a certain threshold of investment income, you're going to get assessed an additional tax of 3.8% on top of whether that income came from ordinary income tax. So if you were paying 37% on that at the top tax bracket, you would actually pay 40.8% because that 3.8% is going to get added on top of that. Or if you were in a high tax bracket and you were at the 20% long-term capital gains tax rate, that would actually be that you would pay 23.8% on that. So how is the net investment income tax calculated, and where does it come from? Well, the net investment income tax is going to apply to all investment income, whether it was part of that preference bucket or if it was part of the ordinary income tax bucket. So even if you have that real estate income, for example, and you maybe have a lot of properties, or you own an apartment building or something like that, and you've got a lot of income coming in from that, that's going to be included in that. And you could be faced with having to pay that 3.8%, not only on that, but on other monies as well. So for 2025, and actually this hasn't changed, I think these thresholds were set up when that NIIT first came out, and they haven't been adjusted. So for single tax filers, it's $200,000, and for married filing joint, it's $250,000. And the way this works is that you're going to pay that 3.8% on the lesser of the amount of investment income that you have in total, or the amount that you exceed the threshold by. So if your investment income is $15,000 and but you're in a single filer and your total taxable income is at 205, you're only going to pay that NIIT on that $5,000 that you're over that amount. So that can be a big deal. That's another thing that you really need to think about. And as you plan, especially going into retirement, where maybe you're thinking about liquidating some of your securities, and maybe, like I talked about in just one of my last videos, getting those bucket strategies set up so that you have some money that's in a more liquid form, that's something more conservative. You may be wanting to sell some of those investments. So that kind of leads that to, do you sell that before you retire? Maybe if you've got working W-2 wages and you're in a high tax bracket, maybe it doesn't make sense to do that. For some of our clients, they may have some years in the early part of retirement. Many people do, maybe most people do, have some low tax years, especially if you retire early, where maybe you don't have any other sources of income coming in. And for some clients, we can actually strategize it where you can actually sell some of those long-term capital gains and pay 0% taxes on that. And that could be something that you could use to raise that liquidity for that bucket strategy. In fact, if we look at this for married filing joint, if we say, okay, our standard deduction is about $30,000, if we add that to the 96, so we can have about $126,000 just by looking at that threshold that goes up to the 0% tax bracket and then adding in our standard deduction on top of that. So we could sell maybe, like I said, $126,000 worth of capital gains. That may represent, depending on what your cost basis is, it may represent $200,000 worth of securities. So you could sell $200,000, and if your cost basis is, let's say, roughly $74,000 or so, you would have that $74,000, because that's your cost basis. You don't have to pay taxes on that, just the amount of the gain. And so that's something that you can look at those lots and those individual securities to best manage and optimize that. But that's a great strategy to look at as you go into retirement. But yeah, the investments get a little bit more complicated. Like I said, there's a few more moving pieces for most people as you go into retirement. But that's it. That's how the investment income works. That's how it's taxed. Just understand that there is that preference rate, and working towards maybe getting your portfolio developed so that it has more of those preference items, I think, is a good strategy for many people. Anyway, that's it for this video. I hope you enjoyed it. As always, if you liked the video, go ahead and hit that like button. If you haven't already, subscribe to the channel. Check out moneyevolution.com, and we've also got some links down below if you'd like to learn about a couple of our programs we do for clients. One of those is our high-end financial plan, standalone plan, not tied to anything with relative to where you have your money invested. And it's just a straight up financial plan. And then that's called the Money Evolution Plan. And we also have our Retirement Time Machine, which is a little bit more of a DIY type of a program where you kind of guide through creating your own plan. And we've got links to both of those things down below. So check that out, and I'll see you back in one of my next videos. Thanks.